So, Hi everyone. Welcome to another day of the Global Education webinar by Global Finance Board. And right now we're going to discuss about accounting. Um, so first, let me introduce myself. I am Oren, one of the financial advisors, a part of the knowledge management team of the group of the GFP. Currently, I'm also the MC Finance of AIESEC Indonesia, and it's really exciting for me to be able to present here for the Global Education webinar. Hopefully, I can deliver some useful information for you guys. And I will not be presenting alone this time. I have Alex who will also be presenting as well. And I will let Alex to introduce himself.
Hi everyone, my name is Alejandro, but everybody calls me Alex, so yeah, that's why you see Alex everywhere, but sometimes also Alejandro in some other places. I am currently financial advisor for AP, so this is for the Global Finance Board, and it's on the KMC team. And I am also currently MCVP Finance and Legal here in AIESEC in Singapore.
Okay, so, by any chance, you can contact me or Alex in through our emails or through our WhatsApp there, as you can see there on the screen. Okay, so let's move on then. For the next several minutes, these are the things that we will hope we can help you understand a little bit better. And the first one is about the accounting standards. And after almost 3 months in our MC term, we really need to make sure that we are aware of the accounting standards that are being implemented or that we want to achieve as AIESEC, especially the accounting principles and also the financial statements, which happens to be a crucial part of the accounting standards themselves. Okay, so now what are the accounting standards? So, as we know that accounting is one part of AIESEC finance standards, and this is what finance does daily. We make reports, we check all the transactions, and we do this because accounting is a process of collecting, recording, classifying, interpreting, and communicating financial information such as our resources, our cash, our equity, our investment, our profitability, our liquidity, and many more. And so this is why accounting is one of the standards in finance operations in AIESEC. And these are the breakdowns or the checklist in the accounting standards. This has already been released by the AIESEC International a couple of months ago. And this is basically the same standards with the previous year. The only difference is that the financial statements is being elaborated more into balance sheet, income statement, and cash flow statement. Back then, it only says financial statements, but in the evolved finance standards, we define it further to be the three types of the financial statements. And also, for the first one is about the double entry bookkeeping system. Double entry bookkeeping system means that every financial transaction has an equal or opposite effect in at least two different accounts that are in either debit or credit side in the equation. So if you are aware of the accounting equation, we have asset equals to liabilities plus equity. So there is usually an account for if we are going to record a transaction in asset. Usually there's an account that we need to record also in either the liabilities or equity part. And then we have the accounting principles. These are all the common rules that must be followed when we are making the financial statements. So because it's a rule, a common rule. So that means accounting principles are something that is generally accepted worldwide. So accounting principles that I use here in Indonesia and the one that Alex used in Singapore or any of you in wherever you are generally the same common rules. So this is why it's so relevant to make sure that we are complying with not only just the national regulation, we are also complying with the global regulation in financial standards or reporting. And the third one is about the alignment between accounting and budget. So this means that we are using the same account name, structure, and everything, so we can compare the budget and also the actual. Because yeah, of course, we have the budget, and then from the accounting processes, we will know how much have we spent, how much is our revenue, how much is our financial condition, so on and so forth. So that means if we have the same structure for both budget and actual or financial report or statements, that means we can compare both of them easily. And then the fourth one is about the financial statements. And as I have explained before, that this time financial statements is further broken down into three types. And the first one is the balance sheet. The second one is income statement. The third one is the cash flow statement. And this should be generated at least once per year. And also the fifth one is the requirement of accounting documents, documents which prove accounting transaction. So we have to be able to keep and store the accounting documents such as invoices, bills, receipts, and every document that basically explain a financial transaction that we are recording during our accounting processes. And then we need to store them physically or virtually, which happens to be like the sixth item in the standards. And also the last one is to align our chart of accounts with the GFP list of accounts. So by aligning chart of accounts with GFP means that we can create the GFP report faster and easily. And if you are wondering what are the chart of accounts that I'm referring to, these are basically the ones that can be found in the GFP survey or in the GFP country entity report that the GFP will send after you give out the GFP survey. And now, there are several accounting principles, and I'm going to break down into some of it. So the first one is economic entity principle. So what does this principle mean is that we are keeping cash for business and personal purpose separate. So AIESEC needs to have its own bank account, separate from President Finance or basically any member bank accounts to prevent AIESEC or personal money being involved when it is not supposed to. So that being said, we cannot use our AIESEC money to pay for our personal reasons. And the same way that we cannot use our own money to do AIESEC activities. So that means, so in that way, we can really tell that the report that's going to be made is purely for the AIESEC operation, and it is purely describing AIESEC's final financial condition. And then the second one is the monetary unit principle. So monetary unit principle is basically saying that all transaction must be expressed in currency or in money. Accounting documents are required to know the amount that can be recorded. So for example, we are recording $100 expense or $300 of revenue instead of 8.58 NPS score or 61% conversion rate. So why does this have to be implemented? Because again, we are aiming to know the financial condition, so that means we need to measure everything in money. The third one is the time period principle. So we have to be able to break down transactions into a standard period of time, for example, month, quarter, or year. So that is why we have the monthly report, and then the data from the monthly report can be accumulated by the GFP or by yourself even to make a quarterly report, semesterly report, and eventually an annual report. And then the fourth one is about the cost principle. So what this principle is saying is basically that we need to record transaction at its original purchase cost. So for example, if we are buying a printer, we are recording its value when we purchase the printer. So we're not using the value of the printer like 1 year later or 2 years later or even a day before. So that means that we need to make sure that everything is recorded at the time and also with the amount that it was purchased. And then we have the full disclosure principle. So this principle requires us to provide all the necessary financial information that may affect the reader's understanding. For example, in the external audit report, there's usually the description of what is happening in each account and also the example of major non-financial information. For example, when we are discontinuing or when we are starting a new exchange product, this means that something really significant happens in the entity and the reader need to know that if there's going to be a discontinued product or we are starting a new product that affects how the financial condition or financial performance between the previous period and also the current period, also probably in the future. Another one is actually the matching principle. So when you record the revenue, you should record all related expenses at the same time. So that means for every revenue, there is a cost that is incurred to gain the revenue. So the expense must be recorded at the same period as the revenue. For example, there's a revenue in the year 2017. So the expenses that are incurred must be coming from the year 2017. So it is not possible for the revenue to be incurred in 2017, but then the expense can only be incurred later in 2018. So that means we need to make sure that the expenses that is needed to generate the revenue are recorded at the same period. So, and then for the rest part of the accounting principles will be further explained by Alex.
Thank you very much, Oren. So now the difference between the session and the actual principle is that you should not just be interchanging things. So if you started with something, you should usually be ending with something. So yes, the consistency principle means that once you implement a principle, a technique or a method, you should stick to it, unless this means like more accurate information. So that's why, for example, in AIESEC we keep using the same chart of accounts so that it can be compared within any period. So because if we add new accounts or if we just take some out without also the proper change management, then this means like the statements are no longer comparable once we changed it. So yeah, we have to be careful when we do so. But also in cases when, for example, there is a thing as depreciation and there's different ways of doing so. One of them is linear and one of them is digressive. So if we started doing linear depreciation for one of our printers, for example, we cannot just in the middle of its life cycle decide, oh, you know what, now let's go digressive. Once we started with something, we stick to that something, and yes, we have to be consistent so it's comparable and also so it's logical. Going concern principle, this means that we assume that the entity will remain in operation for the foreseeable future. So we are not thinking about closing in 6 months. We keep operations as such. And yeah, we can also then check on the balance sheet, the financial condition at a certain point in time. And it's not like, yeah, here it's slightly affected because we thought we were going to close. No, like the the depths and everything should keep flowing normally. Revenue and cost recognition principle. So this means that we record the transactions when they actually happen and not when we receive the money for them. So whenever, for example, we send an invoice to our outgoing EP, this is when they are approved. And this is when we recognize the transaction. So it's like we're going to send an invoice. So this means we got a revenue and we have a receivable. And this is the important part because, like, yeah, it goes then into a receivable because we haven't technically gotten the money yet. But once they pay, because sometimes they tend to take their time, then we cancel that receivable, and that's when the money comes into play. But yeah, it's not like we're gonna wait until they pay us to recognize the revenue. So especially when we're closing a financial year, we may have some receivables, and it's important to like put them all there because, like, let's say I had quite a few EPs for the winter peak, so I recognize all of them, and all of them are going to be paying around March when I already changed my financial year. Well, it doesn't matter, like they are recognized for the winter peak, so this means like the term from before, because also the efforts, the costs, everything was done on that period. So the same thing also goes for costs. So like if we organized a huge event and probably we're going to be receiving some bills later, or if we already have them but we just can't pay them yet, the cost is already there, and then whenever the cash goes, that's another account. But yeah, it's important to always recognize when a transaction happens and not when the money comes in or out. The materiality principle, so this means that something can be ignored if the net impact of doing so has a small impact on the financial statements, so that the reader would not be misled. So this means that whenever you have a small mistake, or most especially if you want to start rounding up numbers so it's easier to navigate, the error has to be minimum, and it's obviously relative. So for example, in a transaction of 1450, if it's supposed to be for 1460, this 10 cents is not really a big amount. However, if it's 100 difference in a transaction of only 500, this is quite significant. But in a transaction of 100,000, this is not really significant, so this is not going to do a huge difference. So yeah, this just means like we have to check like if this is really making a difference, whatever, for us to really go and correct, because sometimes we may find this in old statements that now it's slightly late to change, but also that we can start rounding up and then provide faster data. Conservatism principle, so this means we have to assume the worst case scenario. This doesn't mean that we have to be always negative, but this just means that we should over budget some of our expenses, because more often than we would like to, then we will have some extra fares to pay. Perhaps we decided it was a cool idea to get t-shirts from another country because they were cheaper, but surprise surprise, there tends to be a customs fee, or also the delivery we had to pay more. So it's always better to slightly over budget the expenses while we underestimate our revenues. So if our VP AIESEC is super confident that they can do 500 sales even though we've always done only 50, yeah, we should not like take everything as optimistic as that. We are gonna underestimate it a little bit so that we don't have nasty surprises, because this whole principle, it's about it. Whenever we pay less for something we expected to pay more, it's a nice surprise. Whenever we don't receive as much money as we expected, that's not a nice surprise. So we just adapt to it so that yeah, we can always have slightly more than expected rather than the other way around. Reliability principle, so this means that the transactions must be recorded based on evidence. So whatever transaction that happens should have a receipt. We should create an invoice for it. Always there's a document that certifies like this transaction happened. So yeah, in AIESEC is, for example, we will have the receipt that that we got whenever we bought something. Now, the financial statements are pretty much like what tells us what the situation in AIESEC is, at least financially. So yeah, it's tracking the data over a period of time. So if we want to track what the exchange were, we go to EXPA. If we want to track what the finance looks like, we refer to the financial statements. And yeah, why do we make them? So that we provide useful information for the stakeholders, so someone external can also tell more or less the story. And yeah, this means like we are not making a fraud or something, because they are able to look at this data in the financial statements. This also allows us to do decisions, to do good decisions, not just based on our feelings, but based on data. And this is what keeps us transparent and accountable. So this is why it's very important to make them. There's three main types that we use in AIESEC. The very first one is the balance sheet. So this shows the entity's financial position at any point in time. So how much does AIESEC own? How much do we owe? And have all of our assets been used up? And yes, the next one is the income statement. In some other countries, it's called the profit and losses statement. And this shows the entity's financial performance during a period of time. So how much AIESEC earns, how much they spend, and if they're having a profit and loss. And finally, there's the cash flow statement. So this shows the entity's cash movements and the balance at the end of a period. So the inflow or outflow for operating, financing, or investing activities. Now, the balance sheet, this I always like to describe it as like a picture of like your company or your entity. So yeah, because it's at a specific position in time, and it will tell you how the situation is at that day. So yeah, it's like in day the 31st of March of 2019, we have this amount of cash, we have this amount of receivables, and yeah, it's just like a picture. It tells you how the situation is in that particular moment. The income statement, another important thing to say here is that in the balance sheet, it's where we have the famous equation where assets equals liabilities plus the equity. Here also something worth noting is that in AIESEC we pretty much only have assets and liabilities, and the equity is something we do not touch. The equity is only touched through the profits and losses. This is also where, because all of the statements are somehow connected to each other, so while we know that there's generally four types of transactions that we can have, so asset, liability, expense, or revenue, here we don't see any revenue or any expense. They don't figure out here, but the result of those are going to be either a profit or a loss, and this gets reflected in the equity, and this is why like the equation can also be sustained. So yeah, this is important to know. It's normal that our flyers or marketing that were just an expense won't appear here. Somehow the balance is kept because it's gonna go through the profit or the loss. Next one is the income statement. So this I like to describe more like a video or of a whole period, because yeah, it's the performance during a period of time. So here it won't be like on the 31st of March, but rather from the 28th of February until the 31st of March, for example. So it tells us exactly like what happened during that period. Here, the accounts that we have are the revenues and the cost, or expenses and incomes. And yes, this will then give us a profit or a loss. So it's a profit if the revenues are higher than the cost. It's a loss if it's the other way around. And yeah, as I said before, then the result of this will go into another statement that we don't really use in AIESEC because we don't touch the equity, but this means that then this equity will go until the balance sheet, and this is how they are connected. Next one is the cash flow statement. So it tells us where the cash came from, where it went, and the movement it followed. There's three different types of activities. So the first is the operating activities. So this is from our primary activities. So for example, promotion for OGV. So we spent on there some cash. So it's normal that it goes under there. Investing activities is the next one, so it's cash flows from the purchase and sales of assets that are not inventories. So this means, for example, we sold the flat that we had bought previously. So this gave us some cash, and it was from investments that we had previously done. Finally, financing activities. So this is what we spent on raising and repaying debt together with the payment of interest. So yeah, if we had to go and take a loan at the bank because we were poor, hopefully this is not the situation, but sometimes it may happen. They will charge us some interest, and whatever amount that we're paying there, it's into there. So it's like on the financing activities. This is important because it tells us, like, sometimes, as I said before, like, usually some things come into one statement or the other and not really on both, but they may include cash. So let's say I bought a printer and I decided to use it as an asset, so it's gonna appear on my balance sheet, but on terms of like how much we've spent that term, it's not going to appear on the profit and loss, or sorry, on the income statement. So this is why it can be problematic. However, with the cash flow statement, we will see, oh, okay, so we actually bought a printer. Or like also we can see, oh, we recovered quite some money and it all comes from our receivables. So yeah, seeing where the cash is generating and where it's going, it's quite important because cash is like what gives us our liquidity. And a good metaphor that I've heard from some classes that I've taken is that your cash is like your breath. Like, you need cash to breathe, and you need profit. It's like your food. So it's like, if you don't have any profit for a little while, it can be fine because you can stay for a little while without eating. If you don't eat at all, you're gonna die. But you can stay for a little while without it. However, if you don't have any liquidity, so this is you breathing, then you will die very soon. So you can have the biggest profits ever, but if you don't have any cash in order to pay your debts, for example, this means you will have to be shut down. And yeah, this is why it's very important to analyze it. Now, some final informations and some tips and tricks from us both. So the first is like to have a solid chart of accounts that simplify. This will simplify your job because you don't always have to wonder, oh, okay, is this really like an asset or a liability or an expense? So already having the chart of accounts, but GFB should give you quite a good overview. But also, especially on the local levels, we will have some more adapted accounts. So like out of those, we do sub accounts. And it's like, if it's really solid, then we don't have to be always wondering what type of transaction it was. So yeah, and also a trip there is if we don't know whether it's an asset or whether it's an expense, then if it lasts more than the year, and you can also especially depreciate it or somehow track it, then this is an asset. So an example that I've had even in my entity is to buy a good solid printer. That was quite expensive, yes, but like it's gonna last for at least 5 years. So this goes into the asset, and then later, because it's not just a free, like, let's put everything into assets, we will have to depreciate it, and then this is where the expense will also get affected. But yeah, like whenever there's doubt from your side, think, okay, is this gonna last more than the term? Like, is this gonna last more than like just the activity, for example, that it's gonna be used for? So that's why flyers, even though we may keep them on the stock for a while, if we cannot use them for anything else, then they're obviously an expense. However, if we could keep using them every single year for at least more than a term, then this is an asset. Yeah. Second thing is that storing is very important. And yeah, not everybody can move into fully virtually yet. I have to include myself into those because scanning can be quite a pain in the ass, and like not everybody does so. But yeah, like if you still have to do storage and this is physical, what I recommend is like, because if you don't all have an office, then you can at least have them all in one place and just label the boxes and keep them there. But you need to keep them at least 5 years. And also, according to your country, this may vary and it can be a little bit more. So, for example, back in Switzerland, it's 10 years. Here in Singapore, it's only 8. So, also inform yourself in that. But yeah, just keep it there. It might take some space, but you don't need like 5,000 shelves, or not everybody needs an office. Just keep everything concentrated and keep it there, because we never know when we're going to be needing those documents in order to prove something. So, for example, a refund that somebody claims, and he's like, "Yeah, I had a contract with you guys." He's like, "Okay, from how long ago?" And yeah, if they can prove it, and we can prove that there's nothing there, or like that it's there and we already paid it back, then it's all good. Finally, as said before, the statements are the part that allows us to do fact-based decisions. So if we are not filling them accurately, it's not only that we are not being fully transparent, so it's like the reporting is done badly, but also we are not able to take any decision at all. Here, a bad case practice from my entity was that the local committees were not filling the statements properly, especially the profit and the income statement, since some expenses were just not reported. And then this elevated the ratios quite substantially. So this would then not really mean anything for taking decisions. So yeah, it's very fundamental that whenever we're filling the statements, this is really an accurate um, portrayal of reality. And yeah, so that's really it from our side. I said before, like, here's both of our contacts, so really don't hesitate to approach any of us. We will be happy to answer to your questions or just to have a chat. And yeah, I hope everything is clear. And yeah, keep enjoying the sessions. Thank you very much.